Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll go through our regular market update and our earnings trades updates, and Joe has some charts analysis to go through at the end of that. And obviously we'll take questions at the end, or if you have comments throughout, please just unmute and chime in. All right, thank you. Let's get started. Okay, so indice wise, NDX, Russell, SPX all still in one, holding on to state one right now. Green pie, like we talked about, last week we're at right around 75. So we're down to 60 right now, and we'll take a look at that. We can see we had a pretty big drop in state ones. We were up near our overbought, which was 45. So we were like 43, some kind of in that range. So we were right on the threshold of that overbought. And obviously we've turned lower. We'll look at, see how low we can go here. All right, so first off, let's go to the market pulse. So, last week we were right about here, 43, 42. That was kind of around the high of state ones. Since then, just been, slow decline here. And you can see the twos pretty much been coming straight up. So all the transitions from one are going to two. And then you can see here, the sevens have been pretty much in a down channel since July, what was that, 19th? It's been pretty much straight down. Some of those did go to 5, but not many. So that's where we're getting this pickup in 8s. So kind of a normal type pullback so far. Where it doesn't get normal is if we get 8s, obviously still climbing, but we start to get pickups from 2 to 4. So that's what we kind of have to look out for. But everything pointing right now towards fairly normal type pullback. And I say normal just because like everything's aligned right now. All the major indices are in one. Russell was late to the game, but did go into one. So everything has been aligned so far. Big pie wise, the high was 70, right around 78. We have that normal kind of flat line here for a long time and then turn back down. So, when we turn back down for, bullish, bearish, it's just the matters, we're going to get, what kind of cross are we going to get, or is it going to bounce off, before we get to 50? Usually it does get into that 50 range. But you can see last time here, dropped down to 60, 58, 59, and kind of held there. So that's something I'd look for. Does it get through here, this kind of level, just because of, recent market action and the overall bullishness it's shown? Can we get through that kind of 58 level? If so, then I'd expect a cross, and then, we can figure out after that, if it's going to be a big cross or, like a little, this is a big cross here, and this is like a kind of like head fake type cross. So that's something to look out for. Pull it out, obviously I talked about, a lot about this, back in the bearish market, we're just getting all these new lows. So been getting a buildup of new highs. Obviously they, nothing really in the last week, but this is a good sign overall to see highs coming instead of this whole low thing. So we'll have to keep our eye on that, obviously. The SMAs, we have a nice divergence, good gap here. So it's been closing a little, but nothing huge going on there. Okay, that's it for the market pulse. So let's look at SPX here. Now this has been off the charts for quite a while. So June 13th got above T3. This is really the takeoff point where it retested and just took off. So that's back in June 26th. So since then, we've just been above. So, not too much we can draw from that. Obviously T3 will be important. That's a ways off. Really for SPX, other than it being in state one, which is obviously bullish overall. And, Joe did a great analysis. I think he'll follow up on that a little, about market pulse and things like that. Staying in things a long time. SPX has been in there 85 days, so very long time. So I'll leave that to Joe, but I think more importantly for SPX is the charts. So the key one here is obviously the 50-day. That's 4423. Let's call it 40, 40, 20. So we're still above that. We're at 4480. So this is going to be your first level of downside support, and it's going to be pretty critical support. You can see during this move, the 50-day here, 50-day here, 50-day here, all provided support, which is very bullish. These bullish runs, these 50-day moving averages are important, especially if you see them showing importance. So that's going to be a critical level. If we're going to bounce, obviously, this 50-day would be an ideal spot for, market turnaround. And I'd expect it to provide pretty good resistance to the downside here. Bigger picture, pull out, the range that we're in. So top end is at 46, provide a nice ceiling. This 42, which was pretty good resistance till we broke out of it. That's the way downside. So we're firmly, upper end of this, but obviously the first test in a long time at 4,600 was, failure, pretty strong failure. So, upside 46, downside is going to be our 50, and then below that we have our target 3 for state modeling. That's 43 something, and then below that's 42. So first level to really concentrate on the 50-day, and obviously that changes over time. So last week we were at 44, so now it is kind of leveling out though. So 44.20. So that's our key level. Sorry, this is my kids. So that's it for SPX. Let's look at Russell. Obviously, a little more helpful on the state one chart. Our typical move, kind of go up here, come back, support, and then typically run back up. So I think we look at here, did try and get down. So this is our level of support right here, 1914. So we got down to like 1924 and it had pretty sharp turnaround. That's showing pretty bullish signs. But this is your key level here to the downside for the Russell 1914. Staying above that's obviously good, and then getting through the next levels of resistance. This high for this was 2003 or 204. So getting above that would be very bullish. But 1914 below that, it's 1900 critical, obviously, and we'll show that on the charts here. So we're above the 50-day, so that's something else you can watch, but that's right in the middle of all this. Is 1914, 1900, so it's just a big level around 1900, so that you can watch. This hasn't been as good as the SPX at 50-day, but it is showing it a little here, 2 instances. And if you look at like how it started here, it was a couple instances, and then the third one it took off. So we'll see if really, if these support levels hold, big picture. So, we talked about this, lower highs marginally. This one got up to like 2030. This one was 2009. This one was 2004, basically. So we didn't make new highs, which kind of a letdown, obviously, for people that were bullish. But, all the indicators were showing, we needed some kind of pullback. But so this is the third time since we've been in this, like long-term channel that we busted out a 1900. So third time's usually a charm, but you never know. So critical levels here, the top end of this range would be 2100. So, but really, we got to get above this high, start making new highs. But, obviously the trend right now is down. So we want to watch, the short term, which we talked about, short term trends were pointing lower last week. We still think medium, with everything, how it's showing is starting to show bullish. So big thing we want to watch right now is just, if we do get into these levels, that they hold, obviously at that point we can get, short-term bullish. But, that's what key things I'm watching for Russell and SPX. So we'll just kind of run through these real quick. Next Fed meeting, 42 days away, a long way off. So, we'll have a lot of readings for inflation between now and then, and lots of stuff coming out. Right now it's trending towards nothing happening. And, it's actually dropped a little over last month. So pretty solidly, no expectations right now, but obviously we're a long way off from that. Balance sheet continues to drain. So, we talked about last time, obviously we ran into banking problems here. We talked a lot about last time we had this tightening, it was a 15% decline. So, we're tracking down towards there, but we're still ways off. It's 75 would be 15% pullback from the top here. So, but, Fed's still doing what they're doing, pulling off assets and keeping rates high. So, just data wise, we got some inflation coming out next few days. So that could move markets too. So that's the quick of it for the market. I'll open it up to questions, comments.
This is Dave. I always throw in a couple comments here.
Yeah,
And I'm sorry I was a little late getting in here. I was a new laptop and I didn't have Zoom loaded, so it took me a minute or two. But comments are, there was you may have already mentioned this and I missed it, so I apologize for this, true. But the Fitch downgrade on US, if you mentioned that, it's I think that is having a bigger impact than some people were thinking, maybe, especially when the administration is trying to downplay that. But and I think probably the bigger impact is on bonds than equities. But it's not good whenever a major credit agency downgrades U.S. credit. So that's one thing. The other thing that I may have mentioned a couple of weeks ago, I can't remember whether it was this form or another, but I was listening to several forums on artificial intelligence investing, and one in particular was being hosted by the CBOE. And the CBOE rep made an interesting comment that totally shocked me. He said that over 40%, it was 43, 45%, somewhere in there, of all of the expirations were single day to expiration dated options, meaning that almost half of the percentage of options involving the SPX or SPYs are 1 day to expiration, which kind of kills, in my opinion, the usage of the VIX as a gauge of fear, because now it's like a 1 day gauge of fear and not a
Yeah,
forward-looking gauge of fear. So
right.
that to me was a real kind of shocker. I was really surprised to hear that number, and when it came from the CBOE, I got to believe it's a good number from there.
Yeah.
Since those couple of things happened, and we're through earnings, it'll be interesting to see what Joe says on earnings for the S&P 500 group. But I still think as Apple goes, the overall tech space, SPX and Qs go, and Apple's I think 1 percentage point from a correction right now. So yeah, a little bit dicey for the next till Jackson Hole, and I expect the Fed to be pretty hawkish at Jackson Hole. So I think maybe we're, instead of a melt up mode now, we'll probably be at a range bound, more of a range bound mode up through September, when the FOMC meeting actually adjusts interest rates again or leaves them unchanged.
Yeah. Well, we all know September's a terrible month for equity returns. So
Yeah, that too.
that's like the 1 month, that is, I don't have that chart handy, but it's pretty significant. I think it was like April was second worst, but September by far was like the only one with like negative returns historically, like a historical average. So
I think the only time it was good was last year, Josh. I think last year was up, and it was a weird year, for
yeah.
maybe it was 2021, but yeah, it's not up very often.
Right. Yeah, just like over a long period of time. But yeah, I'm not sure of the phenomenon of that, but yeah. Yeah, it's a good point. Like the 0 DTE, that's what you see a lot of that. That's basically 0 to 1 day expiration. So I think it is skewing the market. Obviously, we've been trying to think about what's really driving VIX, to become useless. That's definitely up there. Joe, did you have any comments on that?
No, just that, I listened to that same presentation. It was Rob Hawking at the SIBO. SPX is their product. And yeah, it was pretty shocking to hear that such a high percentage were those, 1 day options. But that seems to be the way the market has gone. Nothing really to add.
Yeah. Yeah. And as far as the downgrade, I think it does matter. But I think what matters more, I couldn't find too much severe about the Japanese stuff going on, but I did see, Treasury is expanding, like they're putting out more and more loans. So like because of how much how much interest and stuff they had to pay and how much they had to borrow. So that that definitely could be increased supply. You're gonna have to push rates higher and higher. But obviously 10 years is a critical thing to watch. I showed you that chart a long time ago. Let me see if it's still in my drive. I like to always revisit these things. There it is, interest rate and equities. Come on. It's not going to let me rotate there. All right, let me pull it up. There we go. So this is basically weekly stock returns, interest rate movements. I showed you guys this a long time ago, but once you get over 4, the returns are starting to turn negative. Like obviously, this has like 5, but really once you get, I kind of laid out like a 4.5 when things will get ugly. So, or start getting ugly. So, we're at 4. We had a few spikes, but this is something to keep in mind. This is in the chart if you want to look at it, but it's something to keep in mind overall. But the rates.
Hey,
Yeah,
Josh,
yep.
did they have that last graph for the major indices? I mean, it said equities, so I assume it's like all equities, but I mean, did they have that for the, Russell, Qs and the SPX?
No, well, this is fact set. You can see here it's Standard and Poor's. Yeah, so I don't know if they had. This is the only one I found, and I found this in like a presentation probably like 10 years ago, back when as an advisor. I'm like, oh, this is good. I'm gonna keep this. So I kept this for a long time. But yeah, this is it's the only thing I've ever seen like this. So I haven't seen any other good charts like this. And this is just, I guess, S&P. So, but it'd be interesting to see, other factors. But I mean, this goes back to 63. You can see this is back December 2017. So,
Hey, Josh.
yeah.
Josh, it's Lee. We're at this 5% interest rate. We're actually a little over it, right?
Mm-mm. No, that's the Fed fund rate, right?
Oh,
This is 10-year. 10 years
Okay.
the important one. We
okay.
always talk about that, right? Yeah, this is 10-year yield. So that's market driven.
Is that close to 4 now?
Yeah, we're at
Oh.
4.
Okay.
Yeah. Yeah, we talk about this a lot. I think the previous kind of, like bottom was 3.5. It always, pop up. Seems like 3.75. I don't know if it's moved up. We'll see if it's moved up any higher, but 3.75 seems like the new one. But we'll have to see. See if it holds 4. Seems to move like quarter point at a time, but it was at 3.5 for a long time.
Right.
And here it's like did a couple 3.75 tests, and so I kind of moved it up. But this was all 3.5. We had a big move up here, obviously this huge move, and that went up to like 4.33. So that's the high for the last year, and obviously many years. But we'll just have to keep our eye on this. Above 4, I just I don't think it's net positive for equities. And if we go higher, the higher the worse, I think. So if this thing really spikes, I think the market will react, negatively.
All right. Thank you.
Mhm. Did that cover everything for you, Dave? I think I covered everything.
Oh yeah, sorry. Thanks. Yes, it did.
Okay. Okay, anyone else? I did pull up another chart. Mortgage applications from the guy I follow. Pretty interesting. I mean, we're pretty ugly right now. 2015, obviously, was the low, but getting pretty low on applications, and that 10-year affects everything. Your credit card rates, your rates to lend to get a car, housing, all that. So the higher the rates, the more you pay. So pretty significant drop here in applications. We'll see if that's a bottom or not, but something to keep an eye on. Obviously, a lot of people have equity in the houses, and they don't want to start going negative equity, especially people that bought in this craziness. So I think the home prices have, some places have been hit a lot harder. The other thing to watch is like the commercial real estate. Obviously, like San Francisco's had big problems. I think Baltimore, I've seen some stuff there, but nothing systemic yet. But I think, housing prices have definitely stabilized, and it's very localized. for the most part. So, picking a specific area, I guess that's why there's so many realtors, they know the area. So, obviously Florida is different than what's going on in California right now. So, okay, that was it for the market. Anyone else for?
Yeah,
Yep.
this is Lee again. I saw where some banks were put on a watch list. They were smaller banks, but whoever it was saying, be careful of these banks, that the same problem that happened back in March.
Yeah.
You heard about it?
No, I didn't see any watch list, but I've been talking about that. I think I said last week, hopefully the people with the, when you look at that 10-year, where we got into problems, like hopefully these banks were trying to fix their balance sheet, from, this time. But I think this is right when it happened here back in March, right?
Yep.
So they've had some time to try and fix their balance sheets. I said I doubted. I was hopeful a lot did, but I'm sure there's some out there. But I haven't seen a specific list. Do you have that
Nor
list?
have I, Josh.
or-
Oh, no, I'm sorry, I don't. I saw it on the business news this morning.
Oh, okay. Yeah, I mean, you could obviously go through, their filings and try and figure it out.
I think this is
I haven't
Dave.
had time to do that. Go ahead. Good, Dave.
Oh, yeah, sorry about that. But I think that was a justification point in the Fitch rating. I think also back to Lee. But what I saw recently, this might be what Lee is referring to, was European banks. European banks also came out with a downgrade targeted at the lenders as well. And like the USB having to be taken over by the government. I think that's in Switzerland. I think it was kind of
Credit
part of that
Suisse.
story too.
Yeah, that one just got Credit Suisse got in a big trouble. So we haven't heard much ripples after that. Looks like it got absorbed, like no problem so far. But yeah, I would imagine, but like their mortgage industry is a little different. Also, I think it's more of like floating rate, like they get a rate for, and you guys can correct me if I'm wrong. I've only read a little bit about it, but I think it's like a 5-year or something like that, where the rates like get reset for them after a certain period. And I think it's like 3 to 5 years for their mortgages. So, a lot of them had those sweet deals with, negative. So, it's going to hit the consumer, and I think the banks would be in a lot better shape, as these things reset. But I'm not, I'm no expert on that. So, but those long-term government treasuries that they got for negative, man, those things, I mean, that's insanity. So those can't be worth any. I mean, when he got them, they weren't worth anything. You were getting back less than you put in. So anyway, okay. Bullish pre-runners. So get another one closed out. F&B. Let's see, a couple others close out here. So didn't end with a bang, but started very well. I don't think that we have too many more really, but obviously ended up money, but kind of fluttered at the end here as the market turned over. Bullish runners have been doing pretty good. No movers. So we got 4 open. I get 2 up, 2 down. You're up 900. So we've had Nike was the one that closed out a loser. And then these ones closed out recently. Phillips, AMD, both hit the profit targets. So still got 4 open there. Doing pretty well. Obviously, the star of this one has been the the non-mover. Bearish runners, we got quite a few. This is up marginally. Got 2 closed out, 4 open. And both these hit their profit targets, so doing all right. Pretty decent earnings. What do you think, Sudhir?
Going well for me.
Yeah, it's reflected pretty well. Obviously, these strangles aren't doing well, but they're down a couple hundred. So this is the only one that's really not performing. But the best ones have been these non-movers so far. Quite a bit on these non-movers. So that was it. Any questions on earnings? Yeah, like Dave said, we're definitely on the downslope of the earnings. So got like a month until the next plan comes out. So we're on the downslope. Okay. All right, Joe, I'll turn it over to you.
Okay, Josh. Hi, everybody. A lot of places we can go here. Let's see. Maybe, let's see. It's interesting. I think Lee mentioned, the bank situation and, the Silicon Valley March situation. And when I go to the charts, because I thought now that we've rolled over a little bit, it made sense to look at retracements, and I'll get into that. But as I went back to the charts, kind of looking at what point to retrace from, and there certainly have been some short-term lows prior to the March lows, but March I think was the most significant, recent low, and of course that did basically come around the Silicon Valley news. So I will get back to that. Dave mentioned the whole idea of earnings, so just to pull up the Yardeni estimates on earnings, and Josh referenced FactSet earlier. As of Friday, 84% of the S&P had reported earnings. Of that 84%, 79% exceeded, expected estimates. I thought these numbers were high. FactSet's saying that the 5-year average is that 77% of firms exceed estimates. I thought that was, I guess that's what it is. I thought that was high 60s, low 70s, but FactSet's saying 77 on the 5-year average, and the 10-year average, they've got it 73% exceed. Again, with 84% reported, we have 79% exceeding estimates.
Mm-hmm.
I would then, urge you just take a look at 2023 here, and we're in, I guess, an earnings recession. We'll likely have the 3rd quarter in a row where we've had negative earnings year over year. I think through Friday, the S&P earnings were down 5.2% year over year. You can the first column is Yardeni. The second column is like a consensus of estimates. So Yardeni has the 2nd quarter expected to be down 5.1%. The consensus estimate is a little deeper than that at -8. As we've talked before, you can see 3rd quarter expected to be, on the plus side, and then the 4th quarter, according, to the marketplace, they're looking for quite a recovery in earnings. So TBD on that. But let me, as Josh, has pointed out, we're still in state ones, and he also pointed out that the pie is back down to 60%. So, taking some of those historical perspectives we've talked about over the last few weeks, on average, when that pi exceeds 70%, it's 15, 16 days on average where it stays over 70. In this go round, it was 14 days, and then we rolled over. We're clearly still in state one. It'll be interesting to see where we close today. And I think Josh used the term hanging on to state ones, which we are. SPX is 80, 85 days in. Again, all-time longest period for SPX was 136 days. You know, that length ranges from, I think, about 105 days to 136 as the longest periods in state one. Again, we're at 85, and it'll be interesting to see whether we do, you know, hold on to state one. Another thing, you know, kind of perspective-wise, and I guess maybe I'll pull up the chart. So here's the March 13th low. Silicon Valley kind of drove us into lows. There's the SPX low at 38.06. And, you know, there are a couple other interim lows, but I think it's worth noting, and maybe the recent excuse is the Fitch downgrade, but the SPX ran 21% on the March lows. NASDAQ ran, let me see, I got that chart right here, I think. NASDAQ ran 36%, you know, from the March lows. And Russell far less at, what did Russell run? About 15%. But goodness knows, you know, we're due for a correction. And as Josh pointed out, you know, we'll just see whether these lows do hold. I'll go back into SPX, and I think Josh was talking about the 43.23 level as the 50-day moving average. Well, if you you know, run the retracements out of the June low, okay? Let me see, where are we here? You know, this interim June, back here, June 26th, I think there was an interim low in the SPX. Is this it? Bear with, sorry about that. Yeah, right in here. You know, real interim low. You know, those retracement levels take us very close to Josh's, you know, 50-day moving average. So basically, you know, your low in here is 4,300 and change. 5/8 retracement, you know, coming off of this minor low to the high at 46.08 is very close to Josh's 44.23 level. So I think, you know, that's the first level to look for in terms of, you know, this pullback and whether we're going to have anything more meaningful. If, you know, we break through that 44.35, 44.25 level, then I think, you know, we may have another 7,500 points down, and that would take us, you know, down to this target 3 level at 43.39. The 50% retracement, if you go back to, you know, the May lows, takes us very close to that same level, about 43.50. So, you know, the retracements coupled with Josh's moving average, coupled with our, you know, target projection levels, I think are all pretty good support levels as we, you know, see how far this correction is going to go. And it's going to be real interesting to see whether state one holds. Something else in terms of the pie that I'll go back to. When we bottomed in March, March 13th, the green pie was at 21%. We had an interim May low that I mentioned. The pie was 40%. At June low, we were up to about 60%. And then we parked ourselves north of 70 for 14 days, you know, towards the middle end of July and into early August, and we've pulled back. So, yeah, that kind of meaningful low in March, the green pie was at 20%, and we've rallied up just shy of 80. That's SPX. Just kind of supporting some of what Josh is saying. NDX, in terms of pullback there, I think, retracements there. I mean, it was a monster run at 36% coming out of those March lows. I think today's low is around 15,130. 100 points lower would be the first retracement in NDX. 14, basically 300 is, the first retracement out of those March lows in NDX. So, something to look for. Length of time here in terms of state one, the longest ever for state one in NASDAQ is 145 and 142 days. So 91 is still pretty long in the teeth. The next longest state one periods were 124, 112, and 108 days. So, we're approaching all-time long period in NASDAQ as well. And I think, depending on the market, it looked like it was rounding a little bit off the lows in the last hour. I can't wait to see over the next couple of days whether the state ones hold or not. And I guess lastly, Russell, didn't rally nearly as much as NDX or SPX as we know, but, Josh, I think what were you talking about, Josh, that 1940 level, or excuse me, 1914 level as the entry point for, NDX. Well, kind of interestingly, two retracements kind of dovetail into that area. If you take the June lows that I was talking about, 19, which was, basically 18, here it is, on the small chart, 1813, run up to 2003, 1908, which is basically identical to that 1914 entry point is a 50% retracement, in the Russell. And then if you go, back all the way back to the March lows of 1740 in the Russell, the 3/8 retracement of that whole big move is 1902. So that 1900, 1950 range, I think, is a real strong, support level in terms of, maybe looking for entry points in the market if you're a believer. So I think that's a lot of numbers, not too many. As Josh pointed out, we've got some inflation numbers coming up. Some of the Fed governors are out Friday. I think there are three speeches kind of following a couple days of the inflation numbers. So it'd be interesting to see the movement in the markets. Josh was talking about the 10-year earlier. The movement in the 10-year, especially last week, was just absolutely nuts. I mean, I think we ranged from maybe 380 to darn near 425. That kind of movement inside of a week in the 10-year is just madness. We didn't really get the same volatility in the markets, which is kind of interesting, but certainly, the interest rate market is all over the map. So happy to take any comments or questions. Lots of numbers, as always. Maybe more today than normal.
Hey, Joe, this is Dave again.
Hey, Dave.
First of all, I think your presentation is very insightful when it comes to the medium-term look ahead for perspective on where things might be going compared to how they just got to where they are. So thanks for all that. I appreciate all that. That's a time frame that I typically trade in, is the next quarter to 2 quarters out, and so it's very helpful for that. So thanks for one thing. One observation and one question. Since these shorter time frames have, let's say, a more weighted impact that's put on them because of the news, maybe, than the macro environment would have in the year ahead kind of look. I look for trying to find put in my mind the reason for the run-ups that you were talking about that led to the kind of like the recent highs. And so this is what I'm, in my mind, is my opinion / observations, that we were running up, we were in a period where a lot of participants in markets were thinking that the Fed was going to be in a one and done mode. One and done. I think we've done one and done 2 or 3 times now. And that may even be softening now, in my opinion. And if the one and doneers are like thinking, well, maybe there's 2 or more left, it kind of gives justification for some small pullbacks or some range bound activity. The question that I had goes back to the chart that you were showing on earnings and earnings beats, and those were for projected earnings by analysts. That's correct. Yes.
Yeah, on
Analysts.
the right-hand column, that's a consensus of analysts. On the left-hand side, like in 2023, the minus 5.1 for Q2, that's Yardini's estimates.
Okay. Now, so my question is, okay, those are estimates from other sources that were other sources, analysts. So, if we beat analyst estimates all the time, that's great. If analyst estimates are the same all the time, but analysts change their estimates up and down too. So the question is, have the analysts' expectations for the last 3 or 4 quarters been going up or going down as we're beating them?
Dave, we talked about this, I think, once before, and Josh and I cannot wait to begin to try to quantify how much the expectations move coming into the season, and we just haven't been able to get to that yet.
Okay,
we really, because
I didn't mean to beat a dead horse. Sorry.
No, it's all good. I mean, we're all, I think, such believers that earnings move the markets, and so they're so critical. But we just, we're not there yet, unfortunately. So I don't have an answer for you.
Okay. Thanks. Thanks again, though, for your perspective on this time frame. I really enjoy it, and I use it a lot. So thanks.
A pleasure. I enjoy doing it, and I hope that Josh and I we kind of do our own thing here. So honestly, for everybody listening, if you feel there's some repetition or a different direction you'd like us to go, never hesitate to offer those comments. And Josh and I, another thing, we can't wait to do more, but we are still pounding the table trying to get the platform and the website up to speed, and we're not there yet.
Hey, Joe, I have a couple of inputs.
Great, Sudhir.
The data you showed on or talked about just now on the min and max, that something was in state one,
right?
I realize you guys are redesigning the whole website, but that's interesting to have, if it's possible to put in each of these. If you scroll to the top, where you just have the average. If you
Well, what we're going to add, one thing we're going to add, I mean, the new UI, we've got a gazillion numbers on that home page, and, we hope it's not overwhelming. It is the Delphian language, but one thing that we are adding, with all those columns that exist already, we're adding the maximum number. So it's one thing to have the average. It's another thing to have the number of occurrences, but that maximum number will give people some perspective. So we actually
so it's
have
already in the works.
We have implemented that, yes. And I'll tell you another thing that I find really interesting about these extended periods. You got to go in and look at the market itself. Was it an up market, a down market? And when we look at the longest SPX periods in state one, 136, 35, 124, 109, and 105 days. The only recent market was 2021. March of 21 to September of 21, the SPX was in state one for 136, consecutive days. Aside from that, it's 2013, 2011, 2018, and 2017. And I think that, we'll continue to get into the weeds, but, we want to analyze the length of time certain states exist, but then also in the context of, is it a bullish or bearish market? And again, we're not quite there yet, because, depending on that can help to define the expectation for the correction as well, I think. So,
Yeah.
but what else do you have? You said you had a
That's
couple.
very interesting. So I'm glad you're going to put that in. The other thing I had is I really like this Yardeni report. Is that a free report?
It is, it truly is. And so just Google, Edward Yardeni. He's been around forever, but I think he's crystal clear. You don't always get his commentaries, but he's posting, this thing that I have up here frequently. So, yeah, I'm
on his website, and I can't find that exact report. So I'll keep looking.
well, we'll post, we'll post the link, inside of the share drive.
Yeah, if you could post the link. I'm on his website, and he's got so much data. I can't figure out which one is exactly that one you're showing. So it's very interesting to have. So I'll keep looking.
Okay, and we will post as well. Anything else there?
No, thank you.
You're welcome.
Is there a source for a column for how the industry, how each company is, meeting or beating their last guidance kind of thing? They're besides their guidance going forward, I guess you could say if they're either in line or they're raising or lowering guidance. But I mean, the companies give all their own estimates, and their performance towards their own estimations are also important. I don't know if there's a source for that or not. There probably is. I have no idea.
Yeah, Dave, I'm with you. There probably is. Off the top of my head, I don't know what that is. And there are different, sources for data out there, and a lot of this stuff is getting, really expensive. But off the top of my head, I don't know. Anybody else? All right. Well, Josh, back to you.
Yeah, well, thank you, everyone. Any other questions before we wrap it up? All right, thank you all. We'll do it again next week.
Have a good week, everybody.
Thank you.